GST stands for Goods and Services Tax. As the name would suggest, it is a tax on both goods and services, although there are a number of exemptions that we will discuss in class, such as education, healthcare, and certain types of food. GST is a consumption tax because it is paid by the final consumer. However, it is also an indirect tax, as the final consumer does not directly pay the tax to the ATO. It is the supplier, essentially the seller of the goods or the provider of the service, that charges the consumer the GST, and it is that supplier who is liable to pay the GST collected to the ATO. Suppliers need to charge GST on taxable supplies. We will examine this concept in more detail in class, but essentially, a taxable supply is a supply of goods or services made for consideration, generally money, by an enterprise, such as a business, that is registered or required to be registered for GST. The supply must be connected with the indirect tax zone, which in basic terms means Australia. Certain supplies are not taxable supplies and are not subject to GST. These are known as GST-free or input tax supplies, and we will consider some examples of these in class. We'll start with a simple example to show how GST is calculated on a taxable supply. Let's pretend that you go to a furniture store and buy a desk for $220. The desk is a taxable supply because it is a supply of a good for consideration made in the course of a business, which we are going to assume is registered for GST and is based in Australia. Since this is a taxable supply, GST will have to be charged. But how is this amount of GST calculated? As many of you will already know, the current rate of GST in Australia is 10%. When you go to a shop, the prices shown are the GST inclusive prices, meaning no extra GST is added on at the register. The amount of GST is calculated as 10% of the value of the taxable supply, with the value of the taxable supply being calculated as the price times 10 over 11. Another way of looking at this is that the GST is 1/11 of the price of the good. In our example, the desk is $220. The value of the desk is $200, calculated as 220 multiplied by 10 over 11. The GST will be $20, the $200 value multiplied by 10%. So, when you pay $220 to the supplier, in this example, the furniture store, they will keep $200 and will be required to send $20 to the ATO. Now let's pretend that you also run a business that is registered for GST, and the desk you purchased for $220, inclusive of $20 GST, was for use in your office. The desk will be what is called a creditable acquisition. We will discuss this concept further in class, but essentially, as the item is for your business, you are no longer a final consumer. You therefore shouldn't have to bear any of the GST liability. However, suppliers don't know when they sell the goods whether they are selling it to another business for use in their business or whether they are selling it to a final consumer. Therefore, when a supplier makes a taxable supply, they are required to charge GST, regardless of who is purchasing the goods. In order to ensure businesses don't get stuck having paid GST, if you make a creditable acquisition, you are entitled to claim the GST you paid back from the ATO. This is known as an input tax credit. Now, let's work through a more thorough example that will show you how GST operates at each stage of the supply chain. For this example, we will be assuming that all businesses are registered for GST and they are all based in Australia. We will start with a local wool farmer, Farmer MacDonald, who sells wool to a clothing manufacturer, Tyra, for $11. This represents $10 plus $1 GST. Farmer McDonald has collected $1 of GST and will need to pay this to the ATO. Tyra turns the wool into a jumper and sells it to a clothing retailer, Jumpers For You, for $22. $20 plus $2 GST. Tyra has collected $2 of GST, but remember that she paid GST of $1 to Farmer McDonald. Tyra will net off these two amounts and will send the difference of $1 to the ATO. Jumpers For You sells the jumper to a customer, Samantha, for $110. $100 plus $10 of GST. Jumpers For You has collected $10 of GST from Samantha, but paid $2 of GST to Tyra, the clothing manufacturer. Jumpers For You will net off these two amounts and will send the difference of $8 to the ATO. How much does the ATO end up receiving? Well, they should end up receiving a total of $10, representing the $10 GST paid by the customer, the final consumer, who bought the $110 jumper. So let's check. Farmer McDonald collected $1 of GST, which he will send to the ATO. Clothing manufacturer Tyra collected $2 of GST from Jumpers For You, but paid $1 of GST to Farmer McDonald, meaning she also sends $1 to the ATO. Jumpers For You collected $10 of GST from the customer, but had paid $2 of GST to Tyra, leaving them with $8 to send to the ATO. Altogether, the ATO has received $10, $1 from both Farmer McDonald and Tyra, and $8 from Jumpers For You. At the end of each GST period, which will either be monthly, quarterly, or annually, a business that is registered for GST will record in their business activity statement, known as a BAS, all the GST they collected and all the GST they paid and are claiming back as input tax credits. If they have collected more GST than they paid, they will send the net amount to the ATO, like as we saw in the example. If they paid more GST and are therefore claiming more input tax credits than the amount of GST they collected, they will receive a refund from the ATO. To recap, GST is payable on taxable supplies. As an indirect consumption tax, it is paid indirectly by consumers via suppliers. Entitlements to input tax credits arise on creditable acquisitions. This allows GST that has been paid by non-consumers, such as other businesses, to be claimed back from the ATO. Amounts of GST and amounts of input tax credits are set off against each other in order to produce a net amount for a tax period, which is either payable to or refundable by the ATO.